Ladies and gentlemen, good day and welcome to the Gujarat Narmada Valley's Fertilizers and Chemicals Limited Quarter 3 Financial Year 2024-2025 earnings conference call. This call is hosted by Anurag Services LLP on behalf of JNFC. From the management we have Mr. D.V. Parekh, Executive Director and Chief Financial Officer, Mr. Y.N. Patel, Head of Department O&M, Ms. Chetna Dharajia, Company Secretary and Chief Manager, Legal, and other senior members from management. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. D.V. Parekh. Thank you, and over to you, sir.
Thank you, ma'am. And thank you, Anurag Services, for holding the call. And good afternoon and welcome to all the participants for the Quarter 3 conference call of GNFC. First, I'll cover the business aspects and thereafter I'll touch the financial part of it. As you know, the company is mainly into the two segments, fertilizers and chemical. On the fertilizer side, by and large, it's a controlled business in terms of mainly the subsidy part of it. There are three positive developments which are there from the fertilizer business point of view. One is the regular receipt of the subsidy, which is not holding up the funds. Pipeline inventories are also at its lowest as at the quarter end. When we talk about pipeline inventory, we mean inventory pending the DBT sales. The two other positive aspects is government is working on revising the energy norms, which are scheduled to expire by 31st of March 2025. And the exercise is also on at central government level for revising the fixed cost of different urea units. On the complex fertilizer front, basically the scenario has been witnesses quite good because of the reduction in input cost. Now, if you go to the operations part of the business side, the operations have been stable during the quarter, both at Dahej as well as Bharuch. In terms of the projects worth around 2,300 crore are already approved, are at various stages of implementation. My colleague, Mr. Y.N. Patel, will cover questions on the project. On the strategy side, as you know, we have appointed Karni for both growth as well as transformation. And we are in the final stages of wrapping up on the report. And in a quarter or two, that thing would be finalized from a strategy perspective. So this is the broad update on the fertilizer part, strategy part. I'll also cover the chemical part of it. In chemicals, the realizations have been little subdued, which are made up by the higher volumes of chemicals, mainly during YOY as well as on a sequential quarter basis in chemicals. Coming now to the financials, as you know, the PBT and both PAT have gone up on a sequential quarter as well as YOY basis. We ended up with around 211 crore of PBT and 158 crore of PAT. There are two important reasons because of this positive change in the PBT and PAT. One is the certain operational improvement because of the higher chemical volume. And second is there are a few write-backs which have happened during the quarter. So this all totals up to in that incremental figure of around 76 crores on a sequential quarter basis. Coming to the segment part of it, as you know, in chemicals, particularly few chemicals like TDI and technical grade urea have done relatively better on a sequential quarter basis, and technical grade urea as well as few other chemical like acetic and AN melt have done far better in terms of volume on a YOY basis. So when we go to the segment results part of it, the fertilizer losses have reduced mainly because the input costs have come down into the complex fertilizer part. And chemical business has improved both because of the operational improvement as well as side decks we spoke about during the quarter. We'll talk more about these items when there are questions about this. In terms of balance sheet, there is no major change except that the receivable of subsidy have come down, mainly because of receipt as well as the receipt based on the reference point of earlier concession rate, which is higher. So these are the broad things on the balance sheet part. Therefore, in terms of cash flow, there is a positive effect in terms of cash flow, operating cash flow. So these are the aspects with which I am closing my opening remark and leave the floor open for the questions and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nirav Jamodia from Envel Wealth. Please go ahead.
Yeah, sir, thanks for the opportunity and good afternoon to the team. Sir, I have a few questions. So, first on the TDI side, sir, in some of our earlier conversations during the Concall, you have mentioned that our fixed cost for TDI is close to 50 rupees a kg or 50,000 rupees a metric ton. And at the contribution level, the TDI plant on an annual basis was making a loss of close to around 150 to 200 crores. Correct me if I'm wrong here. So, two things here, sir. If you can share that with the shift to the coal-based plant and its current differential to the natural gas prices, how much per kg variable cost can we save with this shift to coal-based plant? And B, how much of the HCl is currently contributing to the negative contribution margin in per kg when we produce TDI out of our Bharuch and the H plant?
Okay. I am D.V. Parikh answering your first question on what will be the differential saving when we switch over to the coal-based power plant. The coal-based power plant is likely to schedule the commencement around 1st of August as per the current plan. There is some delay of around 4 months in that, after which we don't foresee any further time overrun. Upon being operational, the current budgeted figure is around 14,500 rupees per metric ton of saving because of the differential between coal and gas price. On the HCl negative contribution, I am requesting my colleague Sri Manish Upadhyay to respond on that.
Manish Upadhyay from marketing side. HCl is normally variable cost, depend on the market chlorine availability and caustic production. It varies from the 100 rupees to almost 1,500 rupees. Fortunately, GNFC is giving around 500 rupees minus. So we are charging 10 rupees as a cost invoice value, and then we give discount in 500 rupees or something based on the quantum lifting. On an average, it is 500 rupees outflow.
Correct. So it is not materially contributing negatively to our contribution margin. And on that figure of 150 to 200 crores of loss on the contribution level, it is a correct figure, sir, or am I slightly higher on this number?
No, you are close to the number. Why? Because this time, as you know, there was an elongated shutdown at the H plant. As the volumes reduce, the fixed cost goes up on a per metric ton basis. So, roughly we have a fixed cost of around 250 crore rupees per annum at the H plant. Okay. And since we are going to have less volume because of almost 4 months of shutdown, which was originally planned for around 55-57 days. So this time it will have little higher per metric ton figure. Okay. In terms of the loss, because of the unproductive loss which normally happens during shutdown time as well as under absorbed fixed cost, the loss figure would be different than what you are talking. Okay, we'll see at the year end because as of now it is picking up. So we'll come to know finally what will be the number at the end of the year.
Sir, if you could share the figure for third quarter, because third quarter I think we have run the plant optimally after the shutdown. So if you can share for Q3 both the production and the sales figure for TDI as well as the losses. And so these losses are at the contribution level or at the PBT level which you have mentioned?
No, losses are not at contribution level except unproduction cost. We are talking about PBT level.
The
production and sales figure, yes, our colleague Mr. Vayan Patel will cover the production part and sales part. Marketing colleague will take care.
Sir, also if you can share the PBT of TDI plant or TDI operations, that would be helpful.
Sorry to interrupt, sir. You're sounding a little bit distant.
Yeah, if you can share the TDI losses at the PBT level for Q3 along with the production and sales figure, that would be helpful.
Okay. First we talk about the volumes.
Yeah, sir. Yeah.
So you want quarter or?
Quarter and 9 months would help, sir.
Okay.
9 months figure, I'm Vayan Patel answering your question. For TDI2, April to December figure is 20,507.
Okay.
That is for TDI2. And TDI1 you want or?
Only TDI1 also. No, so both.
TDI1 is 14,699.
Okay.
That is April to December.
Okay. And for Q3, sir?
Q3, I will just give in a moment.
Yeah. And sir, second question is on the opening remarks you mentioned about the fixed cost on the urea is set for some revision for different units. I think if I'm not wrong, earlier you have mentioned that our actual cost is close to around 3,600 rupees a ton, and what is actually being paid is like 2,500, 2,600 rupees a ton. So with this revision in the energy norms and the fixed cost also getting revised, is it fair to assume that once if it gets passed through the government, our TDI losses would be wiped out and it will more than cover our deficit of 1,100 rupees a ton, which we are currently losing on?
See, on one side you are talking about urea, on the other side you are talking about TDI. TDI losses has nothing to do with the government actions.
No, sir. I am into my second question. So I think that you said you will just give us in a moment. So I then switch on to the second question. My apologies.
Okay. You have asked for the losses of TDI on a product level basis. See, these are sensitive information.
Okay. No worries.
Which are supposed to be within the company.
No worries.
Product level information, and I don't think not only GNFC, any company shares on a product level basis their profit or loss.
No worries, sir.
Okay. And if anybody is sharing, please do let us know. Okay. Because normally this is supposed to be a very confidential kind of a data.
Correct.
Okay. Now, production and sales figure, you got sales,
yes.
You are yet to receive sales?
No, I have received, sir.
Received? Okay. I think Mr. Vayan Patel has covered production. Sales on a 9-monthly basis is again close to that 22,000.
Okay.
This is the sales of TDI2. TDI1, 15,000.
Okay.
Now, in terms of the volume we are talking, if you want to know quarter 3, it is basically 9 and 5,000 metric ton respectively.
Got it.
For TDI2, TDI1.
Got it, sir. Got it. Sir, on that question of urea, if you can share your views.
Yes. Now, again, it is very clear that depending upon the level which is set for fixed cost, as well as the energy, we will come to know whether we stand to gain or lose. It is very clear when it comes to the revision in fixed cost, it is going to happen upward side only. But whether it will recoup the kind of under recoveries it has is very relative. So very difficult to make a guess, not only for any unit, how much government will revise, what kind of position. Although the exercise is at a very advanced level, we are receiving queries almost every week. Okay, for discussion. We visited there. There is a cost cell assigned to it and all that. So we are hopeful that something should happen in the shortest possible time. What is not moving, in our view, is a change in the energy norm. We had meetings few months back, and thereafter we don't see any movement in terms of interactions with the industry or the units as such. So that is where we feel that whether there will be change or not is not clear. And finally, if it gets rolled over, then it might remain at the same level also. So let us see in a 1 month's time, 1.5 months' time, what actually happens to the norms part of.
Correct. Sir, next question is on the TGU part. I think you mentioned that the prices were remunerative in Q3, and that has also helped to improve our profitability. So I think, if I'm not wrong, I think we produce close to around 190 to 2 lakh tons of TGU on an annual basis. So if you can share how much is the demand domestically, or how much we are currently, India as a country, importing TGU, and is it safe to believe that the prices of TGU in the international market drives the domestic prices of TGU in India? Is it a right assumption to make, or am I different in here?
I'm Manish Upadhyay. The Indian demand is around 5 lakh ton.
Okay.
At moment, and around 2 lakh ton is being produced by GNFC, and 3 lakh ton being imported.
Okay.
And our price is more or less in line with the international prices.
Correct. And sir, for this TGU, are we producing it through natural gas route or through the oil route, like the ammonia which is required for this? It is either produced from the oil or the gas which is available in the market?
It is produced from oil. TGU is produced from oil, yeah.
Okay. So next question is on the AN melt. I think AN melt, we have seen the imports getting reduced, which were predominantly coming into India year back. So if you can share your views here, because I think now Q4 looks to be a good season for AN melt given the pickup in the capex activities which we normally see during this quarter. So if you can share your views in terms of A, the outlook for AN melt, and B, how much we have produced in these 9 months.
Production part, Mr. Vayan Patel will tell. I'll tell about the sales point of view.
Yeah.
Demand is definitely on higher side in quarter 3 and quarter 4 also. It will be reduced in quarter 2 normally when monsoon is there.
Yeah.
And actually production of Deepak Fertilizer and RCF is increasing. So overall, and we are also producing more. So there is a less import compared to the previous year.
I'm D.V. Parikh. This is on the volume. Actually, the 9-month volume is 127,000. And the sales and production are more or less in sync, except for a difference of 1,000 metric ton here and there.
Got it, sir. Sir, next question is on the WNA part. I think we produce more than our actual capacities. Like we produce close to around 440,000 tons of WNA. So let's say after consuming for CNA and AN melt, some rough calculation of mine suggests that we are left with close to around 85,000 to 90,000 tons of WNA which we can sell in the open market. So is this figure correct, or it is slightly lesser than this?
You are close.
Okay. And
that is on annual basis.
Yeah, this is on annual basis. So roughly a run rate of 22,000 tons on a quarterly basis is a right number to work with, no?
Yes.
Correct. And sir, for CNA, I think after our new plant got started, we have a capacity of 166,000 tons. So assuming that, let's say, TDA plant runs at optimum utilization, how much of the CNA is available for sale in the market, which we can sell in the open market?
Approximately 150 metric ton is available for sale as such. Per day.
Okay, 150 metric ton per day. Okay. Sir, last question from my side is on the capex part. I think we are working on two capexes. So one ammonia 50,000 tons and WNA 2 lakh tons. You mentioned some figure of 2,300 crores also. So if you can share the commissioning schedule of both this plant, and out of 2,300 crores, how much we have spent till now?
Okay. See, 2,300 crore comprised of three projects. One is the coal-based conversion, which we are talking, which is scheduled to commission by 1st of August.
Okay.
The capex figure is 613 crores.
Okay.
The WNA has a capex figure of 1420 crore.
Okay.
And the ammonia makeup loop has a capex figure of 225 crore. This is how it totals up to around 2,300 crore rupees. When it comes to the actual commitment, we have already given advance of around 187 crore rupees for WNA.
Okay.
Okay. And in respect of CCPP project, the last completion schedule, we were behind by around 40%, so around 60% capex is committed.
Okay.
This is an LSTK, so commitment is almost full. It is just a matter of giving out the cash flow. Okay.
Correct.
Out of 613 crore, 525 crore worth of project is already given on an LSTK basis.
Okay.
Now coming to 225 crore of ammonia loop, we are yet to commit the capex because there are various work which are going on for the ammonia makeup loop of 50,000 metric ton per annum.
Okay. And the commissioning would be next year, or it could?
We have given in the investor presentation the schedules of commissioning also.
Okay. I will check that, sir.
Okay. If you may check, as we can give you offline also, but it is already part of the information available in the public domain. But still for your information, I'll quickly tell. 1st of August, like for CCPP, 613 crore worth of project. Ammonia makeup loop is somewhere coming by 2027. And around 2028, WNA is coming. 27.
Sir, one more thing, like you have mentioned in the presentation that because of the chemical volumes looking good and the TDI plant also running optimally, the numbers looks optimally better for Q4 of FY'25. So this you refer on a Q-on-Q basis, or you refer on a YOY basis?
No. See, the outlook you are referring to, we believe.
Yeah.
See, whatever is the show in quarter 3 is based on the steady numbers, okay, of production and sales. So, and since we don't foresee any outage, a major outage, we hope that the steady state should continue.
Got it, sir.
And so far, up to this day, 28th of February, there are no major outages also which are witnessed.
Got it, sir. Thank you so much, sir, for answering the questions in detail, and wish you all the best.
Thank you.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Hello, can you hear me?
Yes.
Yeah, thank you very much for the insight. So, the first thought is, if you look at your chemical segment, the margins have improved substantially YOY, even on a quarter-on-quarter basis. So apart from the savings and input cost, which are the products and the chemicals where you're seeing this improvement in margins? Because we are not able to make that out in the spreads you have shown in the presentation. So which are the products where you're seeing this sort of margin improvement, and how do you see the outlook, say, over the FY'27 in these products where you're seeing this margin improvement?
Okay. If you look at, I'm Devi Parikh, if you look at the chemical segment, basically the profits are coming from there. And their ANML technical grade urea are contributing positively, okay, on a both YOY basis and sequential quarter basis. And mainly it is driven through the higher volume.
Okay, so that means you are getting a lot of operating leverage below gross contribution. So in terms of headroom for volume in these two products, what is the kind of additional sales to your growth you can expect, say, FY'26-27?
In AN melt and technical grade urea, you mean?
Yeah.
The capacities, the debottleneck capacity for urea is around 8 lakh metric ton, okay, per annum. And out of that, like we see, we have a RAC, which is normally sort of compulsory production we have to make. Between 8 to 8.3 lakh, you can say. So the balance is the kind of quantity available for technical grade urea. As far as AN melt is concerned, there is an integration interplay. On a standalone basis, we get roughly 500 or 550 metric ton per annum basis. But in case complex fertilizer is not remunerative, we can add up to some more volume into the AN melt, which goes at times up to 650 to 700 metric ton per day.
Okay. No, so when you mentioned the numbers for technical grade urea, your annual capacity is 800,000. You said the RAC is 8 to 8.3. So what is the tonnage you have that you can capitalize on in terms of the technical grade urea there?
Again, I am Dilip Parikshi. RAC cannot be revised to 8. Why? Because the gas-based plant has a limiting capacity. We have a capacity of ammonia of roughly 1120 metric ton per day of ammonia from gas. If you total up on an annual basis on an operating days of around 340, that comes to around 6,36,900, which is the RAC. So let's say tomorrow, if it is increased, we should have a feed available from the gas side of it, which is not possible. And therefore, the balance is going to be technical grade urea, and for which we have the approval also.
Okay, so it is basically the headroom you have in terms of the ammonia that you can divert for technical grade urea. Got it. So the other question is, in terms of the fertilizer segment, when you see that turning around, because there is a lot of capital employed, which is not earning any returns, there is negative returns last year, this year, year to date. So what is required to make it viable and generate at least 10-12?
No, you are talking about the returns on fertilizer or overall returns?
No, I'm talking about the fertilizer segment. If you see the segment number, there is a loss, right, at EBIT level. So if you look at the EBIT on the capital employed before taxes, so when you see that, at least the ROC before tax becoming positive, when you see the segment PBIT on fertilizers turning positive, what is required to achieve it?
See, in case of control businesses, it is difficult because we are not expanding into the fertilizer. And the only leverage in a control business is by and large volume and fixed cost. So we don't see fertilizer segment dramatically improving from loss to profit. Our breadwinner is going to be chemicals, which continues to be the same case as of date also.
Can we conclude that it is driven by whatever growth you can get in with AN melt and technical grade urea, and any growth in the margins you may get in acetic acid and other chemicals? They are not performing now, TDI and acetic acid. So there's some of the kind of growth levers you have for FY'26-'27?
You are not pretty clear while you are talking. Can you come again and be little slow so that we perceive what?
Yeah. So what I'm asking is in terms of the growth you can show in revenue and profits for financial year 26 and 27. Would it be driven largely by the volume growth in ammonium nitrate melt and the technical grade urea, and any reversal in the fortunes in the TDI business, and any growth you may expect in acetic acid? So is that broadly the kind of avenues for growth over FY'26-'27?
See, okay. I would request marketing because it has something to do more with the kind of pricing. Okay. Volume-wise, we have a steady state till the time the expansions fructify. And before that, further volumes are not going to be increasing overnight. Now, as far as price projections are concerned, I don't know what will be the price in 26-27, but still we may listen from our marketing colleague. about any forecast if it is available.
Manish Upadhyay, actually both products are being imported largely, and we need to compete them. So based on the imported price, we'll have to play the price, our pricing. But more or less, it can say it will be steady price, or looking to the last 1.5 year scenario, it will be like either steady or slightly moving upward.
So, I'm Dilip Parikh again. See, to answer your question, what will be the levers? One is, of course, the interplay of the margin which emanates out of the realization and the direct input cost. The other is there are certain transformation initiatives which we are talking internally, and if that fructifies, there is some chance of improving the profitability there also. Okay, both in variable cost and the fixed cost. So for 26, 27, we will be in a position to tell you more closely about this transformation matter in a quarter or two.
Okay, so in terms of the expectations from the capex of 2,300 crores, you mentioned the improvement in savings from the switch to coal for power. So, when do you see that actually showing?
No, we are not getting what is the exact question.
Yeah. Sorry, there's some disturbance in the line. So, in terms of the coal conversion, from the time you commission that coal-based power, when do you get to see the full benefits of that cost saving from gas to coal?
Yes, our current projection is 14,500 rupees per metric ton of TDI, and we are going to get that as per the schedule effective 1st of August.
So from the second half, we'll be able to get the entire benefit on whatever you produce on TDI, right?
Yes, it has to come, and as the gas prices are firming up, probably this may increase also.
Okay, so in terms of the weak nitric acid, that's where the largest part of the capex is going, 14-20 crores. So what are the kind of returns you can expect on that? How do you see that over the next 2-3 years in terms of the returns you can earn on that?
See, there is a projected IRR on that, okay, and we have a threshold beyond which we normally invest, and internally we have a threshold of 14% post-tax, and we have worked out the numbers considering this kind of thresholds.
So if you are expecting that to be commissioned by 28, maybe by FY'29-30, you'll be able to achieve that full impact of the 14% ROC, right? The weak nitric acid.
Should come. It will have a two impact. One is substantial part of this production is going to be part of downstream production, which is of AN melt, and there is going to be some quantity around 70,000 metric ton per annum available for merchant sales.
Okay, got it. So for the last thing, in terms of your cash flows, you're generating a lot of cash flow, right? And you have a 2,300 crores of capex will be done in 2-3 years, and you have 1,000 crore cash flow. So any thoughts in terms of what the additional cash flow will be used for, whether it will be returned to shareholders, dividends or buyback, or you have any further investments you're planning beyond this capex? What are your thoughts there?
Okay. See, buyback is already effected some time back, around October, November 23, of 851 crore rupees. So immediately, and normally as per the regulation, there is a cooling off period of 1 year. As far as other capex is concerned, we are working on some alternatives of what is the possible project. The immediate on hand on which our team is working is that of AN melt. Okay. And we will have the tender is under evaluation phase, so we'll come to know about the size of the capex as we progress further.
Okay, thank you very much. Wish you all the best and looking forward to meeting you sometime. Keep up the good work. Thank you very much.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Govind Lal, who is an individual investor. Please go ahead.
Thanks for the opportunity and congratulations to GNFC entire team for good set of numbers in this tough environment. and guiding for better fourth quarter going forward. I got two questions, sir. So current our margins are in last 8 quarters between operating margins are around 5 to 8% range. And earlier we have done on higher side, I think 25-30% margin also. It is 2-3 years back. So shall we assume that it is the tough in environment and it is the bottom margin reflected and what should be okay, the 28-30% as the best case, and shall we presume this is the worst margin? I think almost in the last 10-12 years this is the worst margin, 5-7-8%. So in regular course, what margin we should take into account, and that is the first question.
Okay. Probably you have taken this percentage from the public domain we are publishing, where we are also publishing the EBITDA data. So that is showing the figures which you spoke about.
Yeah, I have taken from Screener, sir.
Okay, Screener. Okay, fine. Now, Screener will also reflect more or less the same thing which we have given. In fact, our data will be more accurate than Screener because we know the individual line items at P&L level. As far as your question on what is the maintainability of margin, whether it has bottomed out or not, see, these are difficult guesses to make, but our internal perception, including what is available in the public domain by experts, is that the downturn in chemical cycle has lasted longer than expected. So these are just the hopes people can make about whether it's a bottom of the cycle or there is yet further next level of bottom yet to come. So there are no informed guesses which are normally available. But like we said, and our marketing colleague has also said, it all depends upon, predominantly India is an import dependent country when it comes to the major chemicals. Like out of our 10 chemicals, 9 are import parity driven. So it all depends upon what transpires globally, which will have impact in India.
So, thanks, sir, I got it. So, just I was wondering, shall we can presume, sir, like 12 to 15% of margin should be a reasonable margin. I have said about 28-30% lower is on 5%. So, just rough guess. You are best in industry. You have got idea. We are as a layman. I'm asking. So. Can you guide me, sir?
Yes.
So generally, a reasonable scenario, 12-15% margin we should expect.
Okay, I am Dilip Parekh. Actually, your question pertains to something which has to do with macro picture. Okay, and we operate at micro level. Okay. Difficult to make such guesses and tell you that whether it will be 12%, 20% or 5%. Because the way we operate, we normally have a visibility of few months down the line, apart from the overall visibility of how the direction is taking shape. But it has more than one parts moving around in terms of the inputs and outputs. So, regarding the maintainability of margin, if you take the leaf out of the past, probably that would be telling how much we should be in a position to make. But informed guess is not with us as to what will really happen in future.
Got it, sir. Thanks. My second question is regarding TDI prices. How they are ruling, sir, quarter on quarter? Any improvement has happened, sir? Last quarter, what was the average and what is current prices going on?
I'm Manish Upadhyay. Price is improving. Last quarter price was little lower. This at moment price is around 2,10,000 rupees.
So what was the average, sir, last quarter?
It's almost steady, but it was slightly lower than the at moment. So it is improving.
Got it, sir. Then last one question is, what is our dividend payout policy, sir? Some state government have given some directives on this, sir. So what was that, sir? Just I can confirm.
Yeah, that we request our company secretary to respond on the dividend policy.
Yeah, good evening. Am I audible?
Yeah.
Yes. See, dividend policy, actually, you can refer from the website of the company, and dividend we pay as per the policy and the government directives. So it is a mixture of both.
So that was only I'm asking, what is the directive of state government last year they have given, no? What that, just can you summarize? That's what I'm asking. It will be helpful for me.
So dividend would be 30%. Dilip bhai, please correct me if I'm wrong. 30% of the PAT.
30% of the PAT. That is including of buyback if you do.
Sorry?
No, it is not like
buyback. That is including of buyback amount or it is excluding of buyback amount, dividend. 30% is total of buyback plus dividend. That's what I'm asking.
No, it is excluded.
No, just hypothetical question. Suppose if you do buyback also, last time we have done buyback. So suppose we do buyback also and dividend some portion we do pay out. So I am asking this both put together 30% or dividend
No, sir, both
30% buyback
that will be a management decision whether to go for buyback and dividend both. But dividend is a separate decision from management, and buyback is a separate decision.
May I answer your question, gentlemen?
So I am asking, sir, 30% payout policy government has directed state government. I am asking, this is purely dividend or including buyback? These both dividend and buyback put together?
Chetna Ben, may I answer his question?
So that is yes.
Parik, see, the directive is 30% of the PAT or 5% of net worth, whichever is higher, number one. Your question is whether this 30% is after considering the buyback or not. 30% has nothing to do with the buyback as such because it has a reference point of PAT. When it comes to the other reference point, which is the net worth, with buyback, the net worth will definitely reduce. So it will have some impact, but it depends upon which one is higher. So dividend is decided predominantly first based on the guideline and secondly based on what the board decides considering the overall situation and the dividend policy of the company. Is there anything else which is left out in terms of the question?
I got it, sir. I got it. So 30% PAT dividend is assured and this buyback is over and above bonus if it happens. I got it. Thank you very much, sir.
Okay.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Ankur from ICP Group. Please go ahead.
Yeah, hi. Thank you for taking my question, sir. Am I audible?
Yes, sir.
Yes.
Okay. My question is, sir, you mentioned we are a lot dependent on imports. So just wanted to understand the contracts for ammonia and natural gas. Are these long-term contracts and how are they indexed? What is the structure of these contracts? If you can just throw some light on that, that will be helpful. Is there any index or benchmarks that they are based on? Thank you.
Okay. I am Dilip Parik, answering your question. See, if you talk about our key inputs, gas, oil, coal, rock phosphate, benzene and toluene, these are the key inputs for the company. Now, whether there is a long-term contract or not, we have a long-term contract for the gases of urea. We don't have the long-term contract for the chemical part of it. We do have short-term contract and the spot purchases of gas. We have a mid-term and long-term contract for oil, which is worked out based on the mutual understanding about what are the global benchmarks. Okay, for example, in case of oil, there are a few benchmarks like Fujairah, etc. So whatever is the most prevalent, that is what is negotiated upon in terms of the different element apart from the benchmarks. If you talk about coal, we do have an Indonesian benchmark. Okay. So depending upon the commodity, there are benchmarks which are considered after internal evaluation and the inquiries are floated accordingly. For coal also, the buy normally happens on a spot basis couple of times in a year. So this is the third commodity. Regarding the benzene and toluene, it's a mix of spot as well as formula-based buying. Again, when it comes to the formula, it has a benchmark like PETs, etc., which is taken into account. When it comes to the rock phosphate, it is a kind of no reference point negotiation. At times people fall back on phosphoric acid, at times people fall back on some other base, but then it is who wins in the negotiation, who has more power. So that is what happens in case of rock phosphate. So out of our various products of gas, oil, coal, benzene, toluene and rock, these are the ways and means with which we procure, we structure our procurement.
Okay. Thank you, sir. And as you mentioned, some are on the basis of spot and some are there any long-term contracts as well, or these are mostly short-term contracts?
For gas, we do have contracts up to 28, but these are mainly for urea because we don't want to bank on either EPMC or spot and do the inquiry. Okay. And most of the time there is a push from government also to enter into long-term contract and not bank on EPMC or spot.
Okay. Thank you, sir. Thank you so much for answering my question. That's it.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. The next follow-up question is from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Hello. Thank you for the follow-up. So on this transformation exercise you're doing with Sani, I know you said you will share it once you are in a position to, discuss it after the fourth quarter. But in terms of your broad thought process on the avenues of cost savings and incremental growth, what are the kind of key areas you would have possibly identified for this study, just to get your thought process?
Okay. I'm Dilip Parikh answering your question. See, there are various items at variable cost level, majorly, and only some at fixed cost level. Fixed cost level addressing has a structural issue to be addressed, so that's a matter which is yet to be debated. On the variable cost level, there are items like power, fuel, etc., sourcing of oil, etc., which is being firmed up. Okay, and then we'll come to know exactly how much benefit we can expect as against what is being advised to us.
Okay, so basically it's your attempt to reduce the variable cost and improve the contribution of got it. And
primarily, yes.
Yeah, so this is focused more on the chemical business, or you will also look at it for the fertilizer business?
Partly fertilizer also, because urea, as you know, is out of question because variable cost has an impact only to the extent of inefficiency in energy norms.
Sure.
Okay, and inefficiency or our not meeting the standards of fixed costs, which are difficult to meet for most players in the industry. When it comes to the other part, which is the complex fertilizer, yes, this is going to help if there is a reduction in the input cost. Because the base is again oil-based ammonia predominantly, rock phosphate and weak nitric acid.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. D.V. Parikh for closing comments.
I would request the company secretary to place a vote of thanks, please.
Yeah. Good evening, everyone. I'm Chetna here. My sincere thanks to all the participants for active participation. I'm thankful to the moderator and Anurag Services LLP. I'm also thankful to all the members from management team. Thanks, everyone.
Thank you. On behalf of Anurag Services LLP, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.